Revenue recognition is a fundamental principle in financial reporting because it determines when and how companies record income from business activities. Under both IFRS and US GAAP, revenue is recognized when control of goods or services transfers to the customer and the company satisfies its performance obligations. The program outlines a 5-step framework for recognizing revenue: identify the contract, identify performance obligations, determine the transaction price, allocate the transaction price to obligations, and recognize revenue when obligations are fulfilled. This standardized framework improves consistency, comparability, and transparency across industries and reporting systems, allowing investors and analysts to evaluate company performance more accurately and reliably. The first step in revenue recognition involves identifying a valid contract with a customer. A contract exists when parties approve the arrangement, rights and payment terms are identifiable, the contract has commercial substance, and collection is probable. Once established, management identifies the specific performance obligations within the agreement. A performance obligation is a promise to transfer a distinct product or service to the customer. Some contracts contain multiple obligations, such as software sales combined with installation and maintenance services. Analysts must understand how firms separate these obligations because revenue may be recognized at different times. Accurate identification prevents premature revenue recognition and ensures financial statements properly reflect the economic substance of transactions. The third and fourth steps focus on determining and allocating the transaction price. The transaction price includes the amount of consideration the company expects to receive, including variable amounts such as discounts, rebates, performance bonuses, or penalties. Management must estimate variable consideration carefully to avoid overstating revenue. After determining total consideration, firms allocate the transaction price to each performance obligation based on relative standalone selling prices. This process is important because different obligations may be satisfied at different times. Analysts reviewing financial statements should evaluate whether management assumptions appear reasonable and consistent with industry practices. Incorrect allocation can distort earnings trends, profitability measures, and future financial forecasts, potentially misleading investors and creditors. Revenue is recognized when or as performance obligations are satisfied, either at a point in time or over time. Point-in-time recognition typically applies when customers obtain control of a product immediately upon delivery. Over-time recognition applies when customers simultaneously receive and consume benefits as services are performed or when assets are created specifically for customer use. The program illustrates this concept through long-term construction contracts using percentage of completion accounting. Under this method, revenue is recognized progressively according to work completed rather than waiting until the project ends. Analysts must understand these timing differences because they significantly influence reported earnings, margins, and operating performance across reporting periods. Special revenue recognition situations require careful judgment and can materially affect financial analysis. For example, companies acting as agents recognize only commission revenue rather than the total transaction value because they do not control the underlying goods or services. Firms may also face challenges involving customer returns, warranties, subscription models, licensing agreements, or bundled sales arrangements. Differences in recognition timing can create substantial variation in reported profitability among companies with similar business operations. Analysts therefore examine disclosures in financial statement notes to evaluate accounting assumptions and estimate the sustainability of earnings. Understanding industry-specific practices is particularly important when comparing firms operating in technology, construction, retail, and service industries. Revenue recognition has major implications for financial statement analysis because revenue is a primary driver of profitability, valuation, and investor expectations. Aggressive revenue recognition practices can artificially inflate earnings and create misleading impressions of growth and operational strength. Common warning signs include unusually rapid revenue growth, rising receivables relative to sales, channel stuffing, or recognition of revenue before contractual obligations are satisfied. Analysts must therefore evaluate the quality and sustainability of reported revenues rather than focusing solely on headline earnings figures. Transparent revenue recognition policies improve investor confidence and support fair market valuation. A thorough understanding of revenue recognition principles enables analysts to interpret financial statements more accurately and identify potential reporting risks early.